We are standing at what appears to be an inflection point, and the headlines that would have seemed alarmist even 6 months ago now read as simple reporting. On January 26th, President Trump escalated tariffs on South Korean imports from 15% to 25%, accusing Seoul of failing to deliver on a $350 billion investment commitment. Just 2 days later, on January 28th, Federal Reserve Chair Jerome Powell sat before a press conference and delivered 5 words that will echo through financial history. When asked what advice he would give his successor, Powell said, "Stay out of elected politics." That same day, the Federal Reserve held interest rates unchanged at approximately 3.6%, while the Trump administration announced it would reveal Powell's replacement on Friday, January 30th. Meanwhile, India remains under a 50% tariff imposed last August, a punitive measure triggered by New Delhi's continued purchase of Russian oil and participation in the BRICS bloc. These are not isolated policy adjustments. They are structural fault lines widening in real time. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The scale of what is unfolding becomes clear when you step back from individual announcements and observe the architecture. According to the Tax Foundation, Trump tariffs now represent the largest U.S. tax increase as a percentage of GDP since 1993, amounting to an estimated $1,500 per American household in 2026. J.P. Morgan researchers estimate the average effective U.S. tariff rate has surged to 15.8%. Up from just 2.3% at the end of 2024. That is not incremental policy adjustment. That is economic regime change. The World Economic Forum reported in mid-January that global supply chains have entered an era of structural volatility, with geopolitical fragmentation, shifting trade rules, and labor shortages creating constant disruption. UNCTAD projects global growth at a subdued 2.6% in 2026. With developing economies, excluding China, slowing to around 4.2%. This is the environment into which tariff shocks are being injected, one where margins were already thin and buffers already depleted. And then there is the institutional fracture. The Trump administration has launched a criminal investigation into Jerome Powell. The Department of Justice has subpoenaed the Federal Reserve, and the president has publicly threatened to fire the sitting Fed chair. This is not normal political theater. The Federal Reserve's independence, established through statute and defended across administrations, is being tested in a manner not seen in modern economic history. Powell's advice to his successor, "Stay out of elected politics," was not academic counsel. It was a distress signal. When the head of the central bank has to plead for institutional boundaries to be respected, those boundaries are already compromised. Markets price risk, but they cannot price the elimination of credibility itself. History does not repeat, but it rhymes with devastating precision. The Smoot-Hawley Tariff Act, signed into law on June 17, 1930, raised import duties by approximately 20% across thousands of goods. It was intended to protect American businesses and farmers during economic distress. Instead, it triggered a cascade of retaliatory tariffs worldwide. U.S. exports to Europe collapsed from $2.3 billion in 1929 to $784 million in 1932. Global trade volumes fell by 66% between 1929 and 1934. Unemployment, which stood at 8% when Smoot-Hawley passed, jumped to 16% in 1931 and 25% by 1933. The tariffs did not cause the Great Depression, but they accelerated and deepened it by severing the arteries of global commerce. The parallels to today are not metaphorical, they are structural. In 1930, policymakers believed they could insulate their domestic economies through trade barriers while the rest of the world absorbed the shock. They were wrong. Trade networks are interdependent. When you fracture them, you do not create winners and losers. You create a smaller pie for everyone. Between August and January, the United States imposed 50% tariffs on India, raised tariffs on South Korea to 25%, announced 10% levies on 8 European nations set to escalate to 25% by June, imposed tariffs of up to 50% on steel and aluminum under Section 232, and introduced 25% tariffs on semiconductors. Each action triggered a response. India and the European Union signed a long-delayed trade deal on January 27th, explicitly framed as a rebuff to American protectionism. Countries are not sitting idle. They are rerouting supply chains, forming alternative trade blocs, and reducing reliance on U.S. markets. The United States is engineering its own economic isolation, not through malice but through the predictable mechanics of retaliation. There is another parallel that matters. In the early 1930s, central banks were constrained by the gold standard, unable to provide monetary accommodation as trade collapsed and deflation took hold. Today, central banks are constrained by a different anchor, the credibility of their independence. When the Federal Reserve cannot credibly commit to setting policy based on economic data rather than political pressure, long-term interest rates rise. Inflation expectations become unmoored, currency volatility increases. The Peterson Foundation reports that U.S. interest payments on the national debt will reach 3.2% of GDP in 2026, eclipsing the previous high set in 1991. The national debt now stands at $38.43 trillion, nearly 100% of GDP, having increased by $2.25 trillion year over year. Net interest costs are projected to grow 76% over the next decade, rising to 4.1% of GDP by the mid-2030s. This is not manageable debt service. This is a debt trap in formation. And here is where the feedback loops begin. Tariffs raise input costs for American businesses. Those businesses either absorb the costs, cutting margins and investment, or pass them on to consumers, driving inflation higher. The Peterson Institute for International Economics warns that consensus forecasts expecting inflation to descend gradually toward the Federal Reserve's 2% target may be optimistic. Industry data suggests tariff levels of 20 to 50% working through supply chains could result in double-digit price increases for consumers. Forecasters are beginning to project U.S. inflation could hit 4% or higher in 2026 due to tariff effects. If inflation rises, the Federal Reserve faces an impossible choice. Cut rates to support growth, and you validate inflation. Hold rates high, and you trigger defaults across an economy carrying record corporate and sovereign debt. The corporate sector is uniquely vulnerable. Between 2026 and 2028, over $1.5 trillion in corporate debt matures, much of it issued during the ultra-low rate environment of the pandemic era. Companies that borrowed at 2 or 3% now face refinancing at 6 or 7%. Co-face projects, worldwide business insolvencies will increase by 2.8% in 2026, following 3 consecutive years of sharp increases. Allianz forecasts global insolvencies will rise 6% in 2025 and another 5% in 2026, marking 5 consecutive years of increases and reaching a record high, 24% above pre-pandemic averages. The rise of so-called zombie companies, firms whose interest expenses exceed their operating income, has accelerated. These companies survive only because of access to cheap credit. When that credit becomes expensive or unavailable, they fail. Not slowly, suddenly. This is the part most people miss. They see each tariff announcement as a discrete event, a negotiation tactic, a reversible policy. They do not see the accumulation of structural stress. In engineering, there is a concept called fatigue failure. A material can withstand a certain load indefinitely, but if you subject it to repeated stress cycles, microscopic cracks form. These cracks propagate. Eventually, the material fails, not because the load increased, but because the accumulated damage reached a threshold. Economic systems exhibit the same behavior. Trade networks, debt structures, institutional credibility, these are load-bearing elements. Subject them to repeated shocks, and they fracture. The fracture does not happen when the load is heaviest. It happens when accumulated damage exceeds the system's capacity to absorb it. Consider the timing. We are entering the second quarter of 2026 with several overlapping stresses. The Federal Reserve's independence is under direct political assault. just as inflation pressures from tariffs are building. Corporate debt refinancing needs are peaking just as interest rates remain elevated. Global trade fragmentation is accelerating just as growth is slowing. The U.S. government is running a fiscal deficit of 5.5% of GDP, with debt approaching 100% of GDP and interest costs consuming over 3% of economic output. These are not independent variables. They interact. Rising tariffs increase inflation, which constrains the Fed's ability to cut rates, which increases corporate default risk, which tightens financial conditions, which slows growth, which reduces tax revenues, which widens the fiscal deficit, which increases borrowing needs, which puts upward pressure on interest rates. This is not a policy cycle. It is a doom loop. The Conference Board's leading economic index, despite real GDP growth hitting 4.4% in the third quarter of 2025, continues to suggest the U.S. economy will slow in 2026. Goldman Sachs forecasts U.S. GDP will expand 2.5% in 2026, modestly above consensus, but the Congressional Budget Office projects unemployment will rise to 4.6% in 2026, up from an estimated 4.5% at the end of 2025. Unemployment has been edging higher. Job gains have slowed. These are the early signals of labor market weakening. If tariffs drive inflation higher while unemployment rises, the economy enters stagflation, the toxic combination of stagnant growth and rising prices. The Federal Reserve has no good tools for stagflation. Tightening policy to fight inflation worsens unemployment. Easing policy to support employment worsens inflation. The central bank becomes paralyzed and markets lose confidence in its ability to manage outcomes. There is a common objection to this analysis. People say the economy has been resilient. Growth has surprised to the upside. Corporate profits remain strong. Stock markets hit record highs. Why assume collapse when current data suggests stability? This objection misunderstands the nature of systemic risk. Complex systems do not degrade linearly. They remain stable until they do not. The financial crisis of 2008 was not caused by the failure of Lehman Brothers. Lehman was the trigger. The crisis was caused by the accumulated leverage, interconnectedness, and misaligned incentives that had built up over years. When the trigger arrived, the system had no capacity to absorb it. The same pattern holds here. Resilience in the present does not equal resilience in the future when structural conditions have deteriorated. In fact, recent resilience may be a warning sign, not a comfort. It suggests buffers are being drawn down, and there is a further dynamic that accelerates the process. Information moves faster now than it did in 1930. Markets are globally integrated. Capital flows are instantaneous. When confidence breaks, it breaks everywhere at once. The Smoot-Hawley tariffs took years to fully manifest their damage. Modern trade wars operate on a compressed timeline. Tariffs announced in January show up in import prices by March, in consumer prices by May, in earnings reports by July. Retaliatory tariffs hit simultaneously. Supply chains reroute within quarters, not years. The feedback loop from policy to economic outcome to market reaction has been shortened by technology and integration. This means the distance between a policy mistake and its systemic consequences is far shorter than historical precedent would suggest. The Trump administration's tariffs are not random. They follow a pattern. Target countries with trade surpluses with the United States. Justify tariffs through national security or reciprocity. Use tariffs as leverage for broader geopolitical objectives. India was hit with 50% tariffs, not primarily for trade reasons, but for buying Russian oil and participating in BRICS, an alternative economic bloc seen as a challenge to American influence. South Korea was threatened despite being a military ally because its legislature delayed ratification of an investment deal. The European Union faces escalating tariffs tied to its position on territorial disputes far removed from trade policy. This is not trade policy. It is coercion masquerading as trade policy, and coercion creates uncertainty. Businesses cannot invest when they do not know whether their supply chains will be viable in 6 months. Investors cannot allocate capital when policy is arbitrary. Uncertainty is the enemy of economic activity. There are real people behind these numbers. Small businesses that import components and are now facing cost increases they cannot pass on. workers whose employers are cutting hours because orders have dried up, families choosing between paying higher prices for necessities or cutting back on everything else, retirees on fixed incomes watching the purchasing power of their savings erode. These effects accumulate slowly, then visibly, then catastrophically. When unemployment was 8% in 1930, most people still had jobs. When it hit 25% in 1933, the social fabric was tearing. The transition from one state to the other was not gradual. It was punctuated by waves of bank failures, business closures, and cascading defaults. Each wave made the next more likely. The current environment exhibits similar preconditions. The U.S. trade deficit with Asia expanded to $70.8 billion in November. New Commerce Department data shows. Despite tariffs that were supposed to reduce it, this is not surprising. Tariffs do not reduce trade deficits when the underlying drivers are fiscal deficits and consumption patterns. They simply make trade more expensive and less efficient. The deficit persists, but at a higher cost to consumers and businesses. Meanwhile, UNCTAD reports that while global trade value grew 7% in 2025, reaching over $35 trillion, this growth masks significant regional fragmentation. Trade within blocks is growing. Trade between blocks is stagnating or shrinking. The global economy is not deglobalizing uniformly. It is fracturing into competing spheres of influence. This reduces efficiency, increases costs, and makes the system more brittle. And then there is the political feedback. When economic pain becomes widespread, voters demand action. Politicians respond with more of the policies that cause the pain because those policies are politically popular in the short term. Tariffs protect visible jobs in specific industries. The costs are diffused across millions of consumers in the form of higher prices, which are harder to trace back to policy. This creates a ratchet effect. Tariffs go up. Economic pain increases. Political pressure for more protection intensifies. Tariffs go up further. The cycle continues until something breaks. Historically, that something is either war or depression. In 1930, the breakdown in trade and economic cooperation contributed to the rise of nationalist movements and ultimately the Second World War. We are not at that point, but the trajectory is familiar. Federal Reserve Chair Powell's public statement on January 28th was extraordinary for what it revealed. When asked about the future, he did not offer reassurances. He did not claim the Fed had everything under control. He offered his successor a warning: stay out of elected politics. This is an admission that the pressure is intense, that the boundaries are blurred, that the institution's independence is fragile. The fact that Trump announced he would reveal Powell's replacement the very next day underscores the point. The central bank is being actively subordinated to political control. This is not a theoretical risk. It is happening in real time. And once that independence is compromised, the consequences are not reversible with a policy statement. Credibility once lost takes decades to rebuild. Argentina, Turkey, Zimbabwe all offer case studies in what happens when central banks lose their independence. Inflation becomes entrenched, currency collapses, capital flees. The economy enters a downward spiral that policy cannot easily arrest. The wealth destruction implied by these dynamics is not speculative. It is mathematical. When interest rates rise due to lost central bank credibility, bond values fall. When corporate defaults increase, equity values fall. When trade volumes collapse, income falls. When unemployment rises, consumption falls. When asset prices fall and unemployment rises simultaneously, wealth evaporates across all asset classes. Homeowners see property values decline. Investors see portfolio values plummet. Pension funds face underfunding. The destruction is comprehensive. And because modern economies are financialized with wealth held in paper assets rather than physical goods, the destruction is rapid. In 2008, trillions in household wealth vanished in months. In 1930, the process took several years because markets were less integrated and leverage was lower. Today, with global markets interconnected and leverage higher, the speed of wealth destruction will likely exceed both prior episodes. There is an argument that policymakers learned from the past and will not repeat the mistakes of the 1930s. They will act quickly. They will coordinate internationally. They will deploy fiscal and monetary stimulus to prevent collapse. This argument has merit in normal downturns, but it assumes policymakers have the tools, the credibility, and the political space to act. In the current environment, all three are questionable. Monetary policy is constrained by inflation and the assault on Fed independence. Fiscal policy is constrained by a debt-to-GDP ratio near 100%, and interest costs consuming 3% of output. International coordination is constrained by the fact that the United States is the source of the disruption, not a victim of it. When the hegemon fractures the system, there is no one to coordinate the repair. Consider also the velocity of contagion. In 1930, trade and finance moved slowly. A bank failure in Vienna took weeks to impact New York. Today, a default in one market can trigger algorithmic selling across global markets within milliseconds. High-frequency trading, leveraged exchange-traded funds, and derivatives create transmission mechanisms that do not exist in historical analogies. The system is not just more fragile, it is more explosive. Small shocks can propagate with extraordinary speed. This means that the period between stability and crisis is compressed. There may be little warning. One day, markets are resilient. The next, liquidity has evaporated and asset prices are in free fall. This has happened before in flash crashes and liquidity crises. It will happen again, but this time embedded within a broader structural breakdown. The trajectory from here is not predetermined, but it is constrained by the choices already made. Tariffs are in place, retaliation is ongoing, the Fed's independence is under siege, debt levels are unsustainable, corporate defaults are rising, global trade is fragmenting. These are not reversible with a policy speech or a rate cut. They are structural conditions that will take years to unwind, even under optimal policy, and current policy is not optimal. It is accelerating the breakdown. At this stage of the cycle, historically, systems positioned here with these levels of debt, these levels of trade disruption, and this degree of institutional erosion do not experience soft landings. They experience hard corrections. The only question is the timing and the transmission mechanism. Will it be a corporate debt crisis, a sovereign debt crisis, a currency crisis, a banking crisis? Most likely it will be all of them in sequence, each one triggering the next. The most dangerous phase is the one we are entering now, where the data still looks manageable but the structure is compromised. This is when complacency is highest and vulnerability is greatest. Markets price in gradual normalization. Growth forecasts assume policy stability. Risk models assume historical relationships hold. But none of these assumptions are valid when the institutional architecture is being dismantled. Once these pressures align, once the accumulated stress exceeds the system's capacity to absorb it, the adjustment will not be orderly. It will be sudden, severe, and seemingly inexplicable to those who were not watching the structure. The outcome will feel sudden to most, but it was earned, transaction by transaction, tariff by tariff, compromise by compromise over months and years. The mathematics of wealth destruction are already in motion. The headlines are just beginning to catch up.